Good afternoon, friends. I welcome you all for this webinar by Moat Wealth Associates LLP. I appreciate people joining on Saturday afternoon, 12 o'clock. So the main agenda for this webinar is to solve a lot of queries which we are getting from our Marcellus PMS clients. We have been recommending Marcellus PMS since the inception of Marcellus, which was in December 18, and our first client added was in February 19. And it's good to share that the client is still with us. But the last 1 year has been quite challenging. I think a lot of people are worried, are having a lot of doubts and queries on have we made the right decision to invest with Marcellus. And the strategies underperformed the Nifty and the broader indices as well. So to answer all these queries, we have with us Mr. Rakshit Ranjan, who is also the co-founder of Marcellus and has been managing the strategy since inception. So he has seen the last 4 years of the journey as he's managing himself. And so we thought it's good to connect with him at this time when there is maximum pessimism on the street about the stocks which Marcellus holds. And the narrative in the start and during this 4 years was that Marcellus is a safer way to invest. But the volatility of the last 2 weeks, 3 weeks, where 4 of these stocks which Marcellus holds have fallen 10% plus. So we would like to hear more from Rakshit on how are they looking at these stocks and the overall portfolio and the outlook for this strategy going forward. And before I give it to Rakshit, I'll just give you some rules that we are only talking about consistent compounders portfolio. Marcellus also has other portfolios of Rising Giant and Little Champ. So I would request that after Rakshit has finished speaking, then we can ask questions specific to only this strategy. And we will answer most of the questions you can put on the chat box, addressed to everyone or to me. I will ask most of the questions. And please ask tough questions because I want Rakshit to answer all of them, because there are a lot of doubts, queries, because it's not a pretty sign to see a negative portfolio in 1.5 years. So over to you, Rakshit.
Sure. Thanks, Abhishek, and good afternoon, everyone. Thanks, Abhishek, for again reminding us that it's been 4 years now that you've been backing us, and for those of you on the call who are our clients, thank you so much for your trust. Yes, it's perfectly true. I mean, when you look at the last 12 months performance, there is also capital erosion, 5 to 10%, depending on which time period you look at, and that capital erosion is not a pleasant sight. Not just because it's capital erosion, but also because Nifty 50 has done about plus 5%. So there's a 10-15% underperformance as well in CCP, which I totally agree with Abhishek. In most times when the market is weak, and when I say particularly when there are market crashes, we had been talking about the resilience of Marcellus's fund, and that resilience had actually showed up quite a few times in the run up to 2022. But during 2022, that resilience has been absent. Well, the market hasn't fallen by 30%, 40%. Had it fallen, then the resilience, I'm sure, would have been there. But yeah, it's not a good sight to see 12-month, 15-month performance being weak in absolute terms as well as relative terms. So let me put some. Abhishek, can I share slides?
Yeah, I think you're the host now. Yeah.
Okay, thank you. So let me put some context to the last 12 months to begin with. So this is how the fundamentals of our portfolio companies have performed in an absolute way. The top 4 rows in a relative way compared to the bottom 3 rows. We can't do free cash flow compounding computation for Nifty 50, unfortunately, because on aggregate, Nifty 50 actually doesn't have free cash flow, despite the fact that these are large companies and by now should have been generating free cash flow, but they don't, and hence the FCFC AGR line is absent in the bottom half of the table here. But when it comes to rest of the fundamentals, you can see how the numbers compare on a like-for-like basis. There's massive delta, and this delta actually makes money for investors in the longer run. Obviously, in the longer run is the more important point, but at the same time, if for instance you started off with Marcellus 1.5 years ago, and over the last 1.5 years your performance has been weak, then the decision of investing in Marcellus obviously starts getting questioned, as Abhishek was talking about. So should you even be waiting for the longer run or not is the question. Well, given that we are a lot more bottom-up, fundamental oriented in our thought process, we get a lot of comfort from fundamentals, which I'm happy to share in this call. I would actually urge you all to also think about it in those lines, where if you doubt on the quality of the stocks that we hold versus the quality of the stocks that we don't hold, then that's a genuine concern. But if that is not a doubt, then this is just short-term blip, which is the way we see it. Now, that's one piece from a long-term standpoint. When you go to the last 12 months, this is as of December. So apologies, we haven't updated it for the last 1.5 months. But the picture won't change much. So over a 12-month period, these are the parts of the broader market which have done well, and we don't have exposure to anything right till the middle point, right? So we don't have any PSU bank, power, auto, cap good, BSE, PSU components, or yeah. So the top 5 rows we have zero exposure to, in a way, right? And which is what has actually led the Nifty 50 up. Another way to understand why we don't have any exposure to the top 5 is, if you look at the top 10 performers of Nifty 50 in 2022, their fundamentals are represented by the dotted line in the charts on the right, right? The returns on capital employed and earnings growth in the chart at the bottom right, versus the solid line, which is the sort of average for CCP portfolio companies. And the gap between the solid line and the dotted line is what effectively makes money for investors in the long run. If you stay invested in the dotted line, and the dotted line delivers sort of at max 15% ROC on average across longer term, and earnings growth average of say 10-12%, then that's obviously not going to be a healthy rate of compounding in the longer run. But if you're invested in the solid line in the longer run, it's a very healthy rate of compounding. Now, the question as a result should be, going forward, will the solid line versus dotted line picture look the same? Because honestly speaking, over the next 10 years, if, let's say, in the chart on the top right, the solid line remains at 30% and the dotted line remains at 15%, that gap will be driving the outperformance of the solid over dotted in share price terms, and the solid will compound at a very healthy rate. Obviously, the growth also has to come through, which is why the chart at the bottom right is also important. Not just cash generation, but growth in cash generation also has to come through, and which is where I think the next 10 years of dotted versus solid in both the charts on top and bottom is the call effectively that any investor has to make, whether we as fund managers or you investing into a portfolio which is composed of certain types of fundamentals. Now, yeah, this is another way to understand how in the last 12 months there's been a massive disconnect, right? Again, this is till December, where the trailing 12-month performance of share prices is significantly disconnected from the trailing 12-month fundamentals growth rates. Now, there's one very interesting way to put the share price charts of the last 12 months into perspective, right? And for those of you who watch the stock markets very closely, will be able to recollect. So there are, broadly speaking, 3 phases to the last 12 months that we've seen in the stock market. Phase 1 was Jan to June 2022, where thanks to the Russia-Ukraine war, commodity prices shot through the roof. Commodity producers massively benefited, and the broader index was significantly supported by the likes of, say, Tata Steel, JSW Steel, Hindalco, etc., etc. Had we had this webinar in June 2022, I guess the question from Abhishek and the rest of you would be that, well, what's happening here? Why do we not have a Tata Steel, a JSW Steel, a Hindalco in our portfolio? Right? And our answer would have been that, look, they are undergoing a tailwind, which is temporary. It won't last. And over the longer term, Tata Steel, JSW Steel, etc., their earnings growth, their ROC will be significantly lower than that of our portfolio companies. But in the 6 months, yes, thanks to the commodity price tailwind, their earnings growth, their ROC has been healthy only for a short time period. This won't sustain. That's what we would have said. And interestingly, towards the end of June, this tailwind to commodity producers, it completely reversed. Prices started softening down as the global supply chains resumed. At the same time, Indian government put in some extra penalties for exporters, some 30% extra duty on commodity exports or something like that on metals. And what we saw was a resumption to normalcy for the markets, as in wherever you have great long-term fundamentals, share prices, they recovered from the weak relative and absolute returns. And wherever you had sort of just temporary tailwinds, those share prices collapsed, right? So the Tata Steel, JSW Steel, Hindalco, etc., they are no more the stocks which you would have been happy holding on to after June, July 2022, which is where the second phase of the market started. CCP portfolio, it delivered 20% absolute returns and 8-9% relative return relative to Nifty 50. And we had pretty much entirely reversed the weakness of the first 6 months of 2022. So that was how quickly irrationality reversed. And by the way, this sort of 3 to 6 month irrationality is reasonably frequent, and many of you would have seen us go through this even in the past, whether it be the IL&FS crisis or demonetization or the China renminbi depreciation, etc. But I mean, it happens because of capital flows. It happens because of temporary tailwinds to a certain part of the industry, part of the economy where we don't have any exposure in our portfolio, etc. And hence, you do see 3 to 6 month irrationality, which then reverses, and then it doesn't become such a painful sight when you look at your 12 to 15 month performance, because the share prices within 3 to 4 months, they recover from the irrationality, right? That's what happened between July to September, a 3-month period last year. And then started the third phase, where something like an SBI started reporting $2 billion of so 14,000 crores of quarterly PAT. And I mean, those are numbers which obviously would be sustained only if you were to believe that SBI has actually undergone a massive turnaround in their credit assessment, in their credit quality checks, and hence the sort of drop in retail disbursements, NPAs that they reported, right? Recently disbursed retail loan NPAs that they reported, that actually led to Bank of India and Bank of Baroda, SBI, all of these stocks going up by 50 to 100% within 2-3 months, right? That was another new phase of irrationality that kicked off from October onwards. And hence, again, whatever had happened during July to September and the move towards normalcy, it again went towards irrationality and quality. And this is, by the way, all this that I'm telling you is not about Marcellus stocks. This is quality in general. And this is also not about quality of just Indian stock market. This also applies to any, I mean, you can pick up a Fundsmith, a Linsel Train, First State, or Wasatch, or there are lots of funds investing in quality globally, managing several billions of dollars over several decades in the past. In the last 12 months, they've all gone through very similar trends, because these are macro temporary headwinds, tailwinds that apply to the world. So the third phase of irrationality, which actually didn't apply, the PSU bank going up, etc., obviously didn't apply to stocks outside of India, which is where here quality went through another phase of irrationality, and the stock market, broadly speaking, outperformed. Now, had we had an SBI in your portfolio, obviously by now you would be incredibly concerned. Obviously, given how the last 2 to 4 weeks of developments, particularly last 2 weeks of developments have been, around one particular corporate family office, corporate house, and maybe its impact on some of the banks who have lent to that corporate, etc. Right. So that's how we've been through the last 12 months. Now, as I said, 3 to 6 months of irrationality of this sorts is reasonably frequent, happens once in 2 years. But 12 to 15 months of irrationality of this sort has happened in our working life only twice before this in the last roughly 30 years. So once it was in 2002 to 2004. Well, if you look back at the data, it was also there between 94 to 96, but 2002 to 2004, 2001 to 2003 for 2.5 year long period. No matter which high quality company you picked up in India, it massively underperformed. 2012 and 13, again, the same thing got repeated. And 2022, the same thing has gotten repeated. So 12 plus months of irrationality is far more infrequent. But yes, roughly speaking, once in a decade, this has happened in the past as well. How quickly does it reverse? Again, I mean, after every such period, it takes between 3 to 6 months for things to normalize once all the irrationality is out of the way. Is it out of the way now? Maybe. Well, particularly the last week or 10 days of how quality has consistently sort of tried to catch up with fundamentals has shown the as Abhishek was talking about, last 2 weeks, 4 stocks have fallen by more than 10%. But at the same time, in the last 2 weeks, CCP has actually outperformed versus the market by about 2.5–3%. So those we can't time these phases. Maybe we are in the beginning of reversion to normalcy. Maybe it takes another 6 months before reversion to normalcy begins. Nobody can guess that. At least we can't, right? And hence the only thing that we are looking at is fundamentals. As long as they are robust, prospects are good, we are quite comfortable with these companies. Broadly speaking, this is how the PE multiple weighted average 1 year forward for our portfolio has looked like over the last 5 years. So it's not that these companies were at half the PE multiples when the share prices used to perform. It's not that their share PE multiples doubled, etc. Obviously, 1 year forward numbers is what we are looking at. If you look at trailing, then all these lockdowns and all, they create a lot of noise. Titan's PE multiple had gone up to 250 times. Obviously, you would have sold out of Titan if you looked at trailing 12-month PE. But that obviously was abnormal because Titan wasn't allowed to open shops during lockdown periods, right? So that's not the way to look at it. 1 year forward, there's no concern on valuation. In fact, the last 12 months have made valuations even more attractive. Again, this chart is, I mean, once you update it for the last 3–4 months, all that PSU bank irrationality, it'll make it look even more mouthwatering. So that's how we see it. Now, in terms of broadly speaking, very quickly, just to answer the question, are we back to the days when the index become a lot more broad-based in terms of the leaders of the index? No, I don't think so, because when you look at, let's say, decadal performance of the index, decades ending till 2012–13, the chart on the top, the way to read it is 60 to 70% of the index outperformed the index returns. As in, if you looked at, say, Nifty 50, then 30 to 35 stocks outperform Nifty 50 within Nifty 50, right? So look at Sensex, 18 to 20 stocks within Sensex, they outperform the Sensex returns over that decadal period. So that was broad-based market leadership, right? But over the last decade, that leadership has become very, very narrow. There are structural reasons for it, and the reasons are simple. If you look at the leaders of the time period till a decade ago, right, it consisted of all sorts of good and bad quality fundamentals. It consisted of all sorts of debt-laden, debt-free, crony capitalists, high pricing power companies. It was the entire spectrum, right? So to put it very simply, there was, at the one end, there was a Nestle India, and at the other end, there was also an SBI, right, in that list. But when you look at the last decade's leaders, it's been all consistently the high pricing power, not crony capitalists, high cash generative, not debt laden, etc. That's sort of a color. And this is basically the way the country has changed. We don't see it reversing. We don't see the world back to say 90s and noughties where if you've got sort of connections with Delhi, you'll do better as a company in your order book, etc. Even if you don't generate free cash flows, the share price will keep going up, etc., etc. Right? We don't see the reversion to that structurally, and hence we continue to believe that this will be a narrow leadership market, and the leaders will be defined by quality of fundamentals, and quality of fundamentals is what you should keep backing from a long-term perspective. Now, I mean, we can maybe, Abhishek, you want me to go through stock specifics at this point, or let the audience ask about which stocks, when, and what aspect of the stocks they want to talk about? Do I have to? You made me the host. Should I unmute you, or do I need to do that? Okay. Right.
Yeah, actually, we have already got some questions about these 5 stocks. Mainly is DVs, Dr. Lal, HDFC Life, ICICI Lombard, and Berger. So if you can, and Bajaj Finance also is there. So if you can cover these 5, 6, which have actually hit the most during the last 1 year.
Got it. Sure.
Yeah. Thanks.
Right. So, all right. So this is a quick way to look at what's happening to Dr. Lal, right? And these are some very transparently available data points if you were to validate them. So Dr. Lal Path Labs, obviously it operates in the diagnostic space. In the diagnostic space, there's about 7,000 to 8,000 crores worth of organized pan-India players' revenue, right? All of that is, Dr. Lal itself is about 2,000 to 2,500 crores, somewhere around that range. Metropolis, SRL, Vijaya, Thyrocare, Aarti Scans, Anand in Bangalore, Aarti Scans in Chennai, Suraksha Diagnostics in Calcutta. You add all of these together, it's about 7,000, 6,000 to 7,000. Bulk of it is in the listed domain. So barring a Suraksha and an Aarti Scans, all the other names that I took are in the listed domain, so the numbers are readily available. Rest of the industry is either the about 28 to 30 new entrants, Tata 1mg, well, PharmEasy acquired Thyrocare, so Thyrocare is part of PharmEasy, Healthians, all of that. So that's one bucket. You can call it new organized players. And then there are sort of mom and pop labs, as they call it, or unorganized, you can call it, etc. Healthians, so Tata 1mg quarterly run rate of revenue is 30 crores. Healthians quarterly revenue is 10, 12 crores, 15 crores, I think, right? And these are all private equity backed, so numbers somewhere, somehow they come up in some news article, etc. You can validate. So all put together, the new entrants are probably another 500 crores, no more than that. They're not even 1,000 crores in revenue. Now, when you look at, first of all, the market share of the large listed players, right? Market share amongst the large listed players has been captured by Dr. Lal in an accelerated way, right? Some numbers are there in the slide on the screen in front of you, where the gap between the growth rate of Dr. Lal versus the Metropolis used to be not much. It has widened significantly, right? So there is no question whatsoever about market share of Dr. Lal getting weaker versus the other large listed, organized, or dominant regional players, right? Then comes the next part. which is, well, Dr. Lal is not losing share amongst its relevant peers. But then these numbers are suggestive that the 7,000 crore industry size itself is compounding at only 9-10% annually, if Dr. Lal is compounding at, say, 12-14%. So 3 years CAGR of Dr. Lal is now 14, which is a much weaker number compared to, say, 20% plus that we expect Dr. Lal to compound at. So why is this 14, about 5% weaker, 6% weaker than the long-term expected rate, despite market share gains, right? The overall listed industry is, as a result, compounding at a weaker rate. There can be two reasons to it. Either the private equity players or the mom and pop shops have stopped losing share or started gaining a little bit of share from these larger players, or the entire industry has saturated, right? Or a third reason, which I'll come to. Now, there's very clear data available. As I said, this 500 crores of private equity backed revenue size has been built over a 3-year period on a base of 6 to 7,000 crores of industry revenue 3 years ago from these companies, right? So on that base, if you say no more than 2% can be attributed to 2% can be attributed to the private equity players entering. Those private equity players, by the way, in the last 12 months have started sort of significantly reducing their aggression, because the practices that they were following were not sustainable. And now all the Sequoias and Tiger Globals have started pulling out the funding that they used to do for the losses. And as a result, there are rumors that PharmEasy might be planning to hive off Thyrocare, because Thyrocare doesn't get the kind of revenue, loyalty, etc. that PharmEasy wanted. There are rumors that Tata 1mg, Tata 1mg CEO, not rumors, Tata 1mg CEO from July onwards in many newspapers has come in and said that, look, we are not going to burn losses anymore. If that comes at the cost of slow pace of growth, that so be it, so on and so forth, right? So that's not a concern, that the industry growth rate is slow because of these private equity players. That is a point you could have debated a year ago, but last 12 months, particularly, that pace of aggression has totally decimated. Right? M-Fine is shut, got acquired by that lifestyle company, and there were actually many people who exited from Dr. Lal about a year ago who are now planning to come back. Some of the 6 CXOs that, not CXOs, middle managers who had left, and it was a good departure, because Dr. Lal has gone through many such phases in the past, which has only helped the firm transition faster into the newer ways of doing business. Now coming to the last point, so is it that mom and pop labs are bleeding less? There are two likely reasons why that can be true, actually. One, if you look at the pharma OTC drug consumption volume growth in India, right? This is not the Lupin exporting to US. I'm talking about Indian pharma drug consumption. It used to be about 8% volume growth, plus minus 1% pretty consistently until 3 years ago. And over the last 3 years, this has been a CAGR of only 3 to 4%. Right? There's one industry report published by an entity called IMS, which says that if you look back at the last 1 century and all the pandemics that have come out in various countries, in the 1 to 2 years after every pandemic, the population becomes a lot more conservative, a lot more aware, health aware. People wash hands before eating food, so on and so forth. And during that period, there is some moderation in pharma growth, which then reverses, because end of the day, then people go back to their old habits. Now, that might be one of the ways to explain why diagnostics as an industry is growing at 5 percentage point lower than what it used to grow, right? Industry used to grow at 14-15%, is growing at 9-10% in the organized space. The other possibility, which is also a very quantifiable possibility, is that COVID has led to a lot of cash windfall. RT-PCR tests were highly cash generative for every mom and pop lab or every other lab, and that allowed them a longer lifeline to survive rather than shut shop and give market share to to the likes of Dr. Lal, and hence maybe that's another temporary piece. Now, all of these are temporary, and hence I think within the next 2-3 quarters you will see acceleration, reversion to normalcy, etc. Right? You shouldn't be concerned from a long-term perspective because India is not yet at a point where diagnostics is saturated. Right, far from it. Just to highlight one point at this juncture, and we'll go through other stocks as well. Many of you might remember Page Industries of 2019, right? At that time, Jockey was undergoing a massive moderation in its revenue growth. Share price had fallen by 60%. From 36,000, it was down to 17,000 or something. Page was gaining share quarter after quarter from Rupa, Lux, Dollar, VIP, etc. Despite that, Page was not growing at more than 10-12%. And the question marks were, is India saturated on innerwear growth? Have all the wardrobes been filled up with the number and quality of innerwear that they could have been filled up with? And hence, growth rates will be far more modest in future. Obviously, that was temporary. There were reasons why it was temporary. There was massive channel destocking after GST, etc. And that reversed. Once it reversed, now those concerns are gone. The share price has recovered, so on and so forth, right? Something very similar, I think, is expected out of many of these companies that we're going to be discussing today. So that's on Dr. Lal. If there are any questions, you can feel free to stop me. Moving on to Divi's. Now, Divi's is another very interesting company when it comes to the way the business is structured and hence the way the fundamentals progress. So just to remind you, first of all, Divi's is 50% generic APIs, manufacturing for big pharma globally, and 50% custom synthesis APIs, which means patented drugs, again, manufactured for the big pharma. The reason why Divi's gets these orders are, it is not about access to chemistry, which others don't have. Obviously, Divi's does understand the chemistry much better than many of its competitors, but that's not the reason why it gets the business from big pharma. The reason is only one and only, which is dependability, reliability on Divi's for timely delivery of large supplies with high quality of those supplies, right? What Divi's can do is it can deliver in a very timely manner, very large quantities, obviously at cheap prices, but cheap prices even Aurobindo or Dr. Reddy's or somebody else can manage. Cheap prices is not what Divi's gets the benefit of. Is the reliability of timeliness of large orders in good quality of drugs, right? Now, what do you need for that? One, you need incredible discipline and efficiencies at the back end, right? Where no state level challenges, labor related challenges, or raw material procurement challenges, they lead to disruptions in supplies. Then supply chains, once products leave, APIs leave Divi's factories, between here to crossing the borders to getting to the customer, etc. That entire supply chain, you need to manage the logistics, you need to manage regulators, you need to manage many other parts which give out volatility, ability to do that, and then trustworthiness that Divi's won't replicate for its own formulation business. So Divi's doesn't have a formulation business, right? Whereas all other Indian pharma, barring one or two, all other Indian pharma have their own formulation as well as API, right? So obviously then the higher margin APIs, the higher quantity APIs, they don't come to most Indian pharma because they sort of formula chori karke apne liye banate hain, branded generic, etc. Right? So that's why Divi's gets these orders. Now, the organic growth that Divi's has, in a way, I mean, I'm calling it organic as in the same molecule growth, you can call it. Same molecule growth is no more than 7 to 8% CAGR. All the growth that Divi's has exhibited in the past, which is about 22 to 24% revenue CAGR, only 8% out of that, roughly 1/3, is same molecule growth. The remaining 2/3 is new molecule addition. because particularly for the patented drugs, their life is limited. Once they go off patent, then the number of manufacturers go up, the prices go down. Of patented drugs are far lower in margins, etc., and many a times the big pharma manufacturer also changes, right? They are interested only till the time that they are under patent or they are making ROCs for the big pharma. So it creates a lot of lumpiness, and hence the ability to acquire newer drugs means that the quarterly revenue growth for divis, as you see in these bars, is very volatile, has been very volatile forever, right? This is the last 20 years. You can see the average is 20, right? As I said, 22 is the precise average. Average is 20, but there'll be several time periods where quarterly run rate is above 40. Let's say if you can see my cursor here, and then there'll be several time periods where the quarterly run rates are below 20 minus, right? So this was one, the encircled pieces, right? This is the nature of divis. Can you predict it? You can't. The share price does react to it, right? If you see, for instance, say 2017 or 2013, the share price recovery started way before quarterly run rate of fundamentals exceeded 20, 25, 30% after having corrected. It is not that you can be a very smart investor and say, well, let me track quarterly results. The day the quarterly results suggest the divis has started growing at 20, 25, 30, we'll buy it, right? That does not happen. This management can't give you guidance. Remember why? Because their whole business is built on secrecy and trust of the formula and volumes. If they give guidance in a quarterly call to you and me, right, and say that, look, we are going to launch 3 large APIs in this particular segment, which will deliver volumes of this quantum, right? It's a breach of trust. At the same time, the big pharma won't give divis an incredible month-by-month visibility that, look, you keep manufacturing and 3 months out, we are going to take the manufacturing volumes up 5x, right? They will just say, divis, right from the beginning, be ready for large volumes in future if you successfully keep supplying high quality on time to us. And just keep at it. We'll tell you how much to manufacture for the next 1 month, right? So visibility to the stock market for the next quarterly volume growth, with somebody like a Maruti Unilever or somebody else can easily give, divis can't and wouldn't. As a result, the share price tends to be very volatile, fundamentals whenever they exhibit volatility. What has happened in the last 12 months? Many of you might be aware, there's one big reason, which is the fact that molnupiravir was one of the COVID-related drugs that they were manufacturing. After COVID, the demand for that drug collapsed, and hence that drug had accounted for 18 to 19% of revenue of divis. So that 18-19% is almost completely zero now over the last 3 quarters: June quarter, September quarter, and December quarter. What's even more remarkable is that the way divis delivered these COVID drugs in the past, I mean, it has opened doors to many new types of business lines in future. So divis delivered within 3 to 6 months a new molecule which nobody in the world had manufactured. Merck was the manufacturer here. Molnupiravir was the molecule. Divis delivered the quantities on time to Merck, which gave Merck the confidence that, look, when it comes to new molecule manufacturing, you don't need to give molecules to divis only in stage 1 trials, which then move to stage 2 trials, then stage 3 trials, then commercial production. It's a 3-4 year long journey. You can actually, if you're unhappy with one of your existing manufacturers in stage 2 trial, you can actually start giving to divis from stage 3 trial onwards, which is very close to commercial manufacturing with very high visibility of commercial launch, drug approval from the government, etc., etc. That's a new line of business that nobody in the world. Lonza and divis are actually, those of you are aware of this space, Lonza and divis are the only 2 reliable back-end manufacturers for patented drugs, and divis has proven something that even Lonza hasn't proven in this particular aspect over the last 2 years. That's opened up a massive windfall for new revenue growth, and Hence, you will see over the next 2-3 quarters gradual, if not sudden, pickup in revenue growth rates, right? And then the share price recovers. Can we time preemptively? We can't. Can we react? Yes, we can, and which is what we've done. Both for Dr. Lal, in the month of May, we almost doubled our allocation for all of our clients. So those of you on the call who are CCP clients, you would have seen that in the month of May, we doubled Dr. Lal for you. In the month of November, we almost doubled DVs for you. From 3.5% of the portfolio, it went up to 7+. And that's the way we can react to this, so that we are not speculating on future, which can be volatile in the near term, right? So that's divvies. There's absolutely no concern here. We've spoken to Merck. In fact, as recently as this week, again, we've spoken to many of the other customers of divvies, and very clear idea that there is absolutely no reason to believe that there is a weakness in the franchise. On the contrary, there's massive strength in the franchise. But yeah, quarter by quarter, difficult to time, and hence we react rather than preempt.
So one related question is that since you are tracking this stock since many years now, the chart itself is from 2004. So how many quarters of more pain is left as per your best guess? Because you said it is not guided openly by the management ever.
Correct. So look, we doubled in November because we can see that, look, there's a lot of pain factored in, which is not justified. Whether it continues for another 6 months or 3 months or 1 month, this is an opportunity which shouldn't be missed, and hence we doubled, right? The way it has corrected even after that, I think we doubled at around 3,500. It is down from some 5,000, and it is now 2,800 if I'm correct in recollecting. The way it has kept on falling, if there's opportunity to even benefit again in a meaningful way, we'll do it again. How many months more? Maybe 1 quarter, maybe 3, but certainly not a significantly longer amount. That's on the fundamentals. On the share price, it won't wait for complete fundamental recovery, is what I can tell you. I don't know. I wish I could answer these questions and I'll be the happiest man on earth. But we can't answer, right? We couldn't have taken cash calls on any of these stocks that I'm talking about, right? So that's divvies. I don't know if any of the paint stocks are concerned. So Asian Berger, in fact, Berger is gaining more market share than Asian from the rest of the industry. This quarter again, this is still second quarter, third quarter, Berger has grown again faster than Asian. So there's no concern there either. These are not stocks which have fallen by 50%. Bajaj Finance has, in fact, 8,000 down to, I think abhi thoda recover kar gaya hai. This one also we added about 1.5% more to all of your portfolios in November. This stock again is a massively evolving franchise, and I mean, it's quite funny the way Bajaj Finance's share price reacts to. I mean, DV's ke case mein fir bhi you can say 20-25% drop in revenue. Anybody who would read it, if they don't know the business, they'll be concerned. But Bajaj Finance ke case mein to utna bhi nahi hota hai. Instead of a 30% expected loan book growth, if 28% gets delivered, then the market spooks up. I remember jab World Cup 2019 chal raha tha, cricket ka, Sanjeev Bajaj had come on TV and said ki televisions ki sales have been less than expected during this World Cup. Bajaj Finance corrected by 25%. Only on that one statement within the next 3 days. Similarly, 2018 mein they were. So Bajaj Finance has had several such crashes. This is another one. If you want to understand how we view the business evolving, well, there are many ways to look at it. One, if you look at their existing customer mix in the new loans, right? So new disbursements, how many of them are to cross-sell, upsell of existing customer base? That number is only inching upwards, right? From 50s 5 years ago, it is now comfortably in 60s consistently, averaging around 53, 64, table on the top, which is a very healthy way to grow. Why? Because Bajaj is also evolving significantly as a company. It's no more just a lender, right? Those of you who are actually customers of Bajaj, you would have seen Bajaj give you a wallet now, just yesterday, I got a mail. So I'm a customer of all of our stocks, if I can be, barring divis, obviously. But you would have seen a credit card email come yesterday from Bajaj Markets and consumer durables, so on and so forth, right? This is the pace at which that franchise is evolving. If you look at the chart at the bottom left, right, in terms of net installations of new customer acquisitions during the quarter, right? This is how that is leading to strengthening of the business. Assets under management or loan, right? Loan book per cross-sell franchise, as in existing customer, which is about 62-63% of the average disbursements. Loan per customer has compounded at 3% over the last 5 years, but PAT per customer has compounded at 14% within the existing customer base, which means that with only a 20-21% new customer acquisition run rate, which is not a very bad run rate, actually, a very high run rate, actually, because if you look at Kotak, HDFC, forever, if you look at the whole credit in the country has grown at 13 to 15% annually, without much of growth in AUM per customer, obviously, and hence there's massive volume growth to be had at an industry level itself. Bajaj is not exceeding that industry volume growth by a big mile, but by cross-selling and upselling to the existing franchise, their overall profit growth is higher quality and much higher run rate, right? Which is the sort of 40% that they reported in the third quarter as well. And here you can see why it is happening. The profit per customer itself is compounding at a very healthy rate before they acquire new customers, and hence the overall profit has been compounding at a very healthy rate. Third quarter, again, as I said, which is not part of this table, is 40 point something percent. Core fee income, which is non-lending ways of generating revenue, right? Core fee income per unit loan has doubled, right? Why is this? This is all because of all the fintech-oriented services that Bajaj Finance has been offering. Now, this is how we understand the business's evolution. अभी उसके बीच में संजीव बजाज टीवी पे आके बोले टीवी नहीं बिके वर्ल्ड कप में, या 2% से लोन बुक ग्रोथ एक क्वार्टर में कम आए and the stock crashes by 20-25%. I mean, that's nothing other than an opportunity to buy more rather than cursing yourself, why was I exposed to Bajaj अगर टीवी नहीं बिकने थे वर्ल्ड कप में, right? So that's how we see the business evolving. There are lots of other charts, but it'll get a little technical. Overall, very, very comfortable. I mean, this is what Bajaj is giving. If you look at these two price point columns, right? Amazon versus Bajaj Mall. Those of you who are customers, actually, you can pick up these prices. We picked it up from our mobile app. In many cases, Bajaj is offered product prices to the customer via the zero cost EMI is actually way lower than what an Amazon will offer. In many cases, even if you don't take the zero cost EMI, these are the prices you will get, by the way, right? It's not that only with a zero cost EMI you'll get these prices and hence Bajaj earns through subvention. Even without the lending piece being there, Bajaj earns through subvention on selling a Samsung, a Hitachi, a Whirlpool, etc. on their Bajaj Mall compared to even an Amazon, right? So that's how much fast evolving this business is. It's challenging the largest, the most efficient incumbent dominant players in areas such as payment interfaces with Bajaj Pay, right, which is substitute to Google Pay in a way for the customer, e-commerce, and aggregator for financial services products, for which the fee income comes to Bajaj without balance sheet risk, right, on the loan side. So that's Bajaj. Stop me again if you have any more questions. I realize, and we can go on and on. Yeah, it's been 55 minutes. So I'll rush into this now. So HDFC Life, right? Stock price corrected. Now it is recovering. After budget, the market adversely reacted to that 5 lakh plus premium, not getting the tax exemption, etc. Well, to put it very, very simply, that if you had tax exemption as one of the objectives as a customer who pays more than 5 lakhs of premium, which is about 10% of HDFC Life's overall premiums, right? If you add the tax exemption on top of your mind, you will very comfortably split that policy. I mean, your agent, your bank insurance partner will tell you that, look, 5 लाख आप अपने नाम पे लेने की बजाय 2.5 लाख अपनी वाइफ के नाम पे ले लो, 2.5 लाख अपने नाम पे, या फिर 3 लाख अपने एक बच्चे, 3 लाख अपनी वाइफ, etc. That's how you split a 10-15 lakh premium per year. And industry has seen many such. And then there are massive market share gains. See, every time there is adversity which applies to all companies in an industry, that becomes an opportunity for the strongest player to gain market share, right? We've seen that through COVID. We've seen that through demonetization. We've seen that through Russia-Ukraine price war. Russia-Ukraine wars, pricing impact on commodities as raw material inputs to many of our portfolio companies, so on and so forth, right? So net, in the worst case scenario, we don't expect 3 to 4% of business of HDFC Life to be exposed to this. More importantly, the way the business is growing, accelerating, the way the competition is becoming weaker, and this space becomes less attractive through regulatory changes such as these for the weaker players. This only becomes a greater and better franchise. If somebody is worried that Indian life insurance industry's runway for growth is significantly curtailed because of this, well, I would suggest you think twice, because India is, particularly in insurance, India is far, far more underpenetrated than even lending. There's a very long runway ahead before which you can talk about saturation of runway for growth. The number of players are very limited within that. Nobody knows how to underwrite barring 2 or 3 players. HDFC Life is the best amongst them. That's all you need in the long run for an insurance company to succeed, make money, and grow at the fastest pace. That's HDFC Life. This is ILOM. ICICI Lombard, if you look at since FY17 particularly, their profit market share has only been going up. Yes, it did drop from 16 to 17 when they decided not to be in certain lines of business because the profitability wasn't good enough, and now in the last 6-7 years it's only been going up. Bharti AXA acquisition adds massive muscle. ROE is very healthy, and there's, honestly speaking, not much of a concern that we have in the most recently reported fundamentals as well, for non-life, right? I mean, I don't think many of you will have questions on HDFC Bank Kotak now. If you do, happy to answer those as well. वो questions होते थे जब Bajaj hadn't fallen, but HDFC 1400 पे अटका हुआ था 4 साल से, 3 साल, 2 साल से, whatever. Right? अभी I think 1400 से 1600 हो गया, तो people have stopped asking us questions on HDFC Bank.
The life insurance business, as you said, HDFC Life, ICICI Lombard, and if I add Dr. Lal and DVs also, now they have completed nearly 2 years of no return, nearly, maybe. And so my question to that is, when do you sell? As in,
again, I mean, so Abhishek, sorry to interrupt, but if it was these 4,
yeah,
I'm sure you can find many PMSs who don't have these 4 but have quality.
Correct.
वो वाले PMS ने तो आपको कंसर्न ना दिया होता ना, आपको सारे क्वालिटी PMSs ने कंसर्न दिया है, ठीक है? Next, if it was about Indian quality, so at a global level, quality oriented portfolios would have delivered healthy returns in the last 1 year, right? So I mean, I'm just trying to correct the framing of the question. The pain point is not these 4 stocks. The pain point is last 12 months quality as a basket has not delivered. That is the pain point. If you want to talk about particularly these 4 stocks, at any point of time in our portfolio of 14 stocks, you've had 2 or 3 undergoing exactly the same types of share price oriented challenges because fundamentals in the recent quarters would be weak, etc., right? As I said, 2019 mein it was Page, 2020 mein it was Bajaj Finance, 2021 mein Grasim entry into Asian Paints, 2022 mein Dr. Lal and DVs, and 2023 mein might be something else. You will never have a period where 14 quality stocks of Marcellus mein se 2-3 पे कंसर्न नहीं है क्योंकि 2 साल से शेयर प्राइस नहीं चला. By the way, Dr. Lal was flat at 1,000 rupees a share between 2016 and Jan 2017. We actually started buying it in our previous avatar in the PMS that we used to run there. 2016 to 2019 end, Dr. Lal was absolutely flat for 3 years. And then it became 4x. Even now it is 2x of that level from 2019, right? So, yeah, you're right. These are 4 pain points that we can talk about today. As I said, 1 साल पहले हम बात कर रहे होते ना, तो ऐसा नहीं है कि क्योंकि डिवीज तब तक गिरा नहीं था तो पेन पॉइंट ना होता. तब HDFC बैंक पेन पॉइंट था, राइट? तब I'm sure Orbi you can pick up companies which were pain points. So this will be part of the journey, and this is not, I mean, I'm not, my own entire wealth is in this, right? So I'm not saying this as an outsider. I'm a client of Marcellus myself. Just that we've seen many of these things in the past. We know in the long run, the only thing that matters is great quality management, doing great capital allocation decisions to kill competition and come out with newer and newer disruptive ways of growing the franchise forward. That's all that matters. Does it happen every quarter? No, it doesn't. Does the portfolio then go through a lot of volatility? No, it doesn't. Last 12 months, as I started this call by saying, last 12 months have not been normal. Last 12 months, long pain of irrationality is once in a decade phenomenon. Usually irrationality persists for 3 to 6 months and then goes away, right? So last 12 months have been infrequent, but yes, not the first time. This has happened in the past.
So if I give you new money now, or we add in the existing portfolio,
I can tell you what I'm doing with my money. I know everybody will know the answer. So sorry to interject. I know I've taken more than 1 hour. That's why I'm preempting a question and finishing off. So previously, when I used to get my salary and after paying for my credit card, that's how my mind works. Simple. Salary आई, credit card bill दिया, बाकी का अंदर top up. It was okay for me to wait for 10, 15, 20 days and then do the top up. I was not so eager. Abhi, I'm going in right. I mean, last 2-3 months. Obviously, the main reason being because I know when the recovery happens, पता भी नहीं चलेगा, पीछे 1 महीना पलट के देखें तो लगेगा अरे हो गया, and then you are waiting, अरे 5% नीचे आ जाए तो डालूं, and 3-4 महीने में सारी recovery हो जाती है, right? That's how it was July, August, September last year. That's how it will be, whether this year or next year, whenever the recovery happens, I don't know, right? But I'm not waiting. But having said that, yes, in our client base, where we've seen net inflows for the last 4 weeks again, after we saw net outflows between first week of December and first week of Jan, 4-5 hafta we saw net outflows, but abhi wapas net inflows hai. We are seeing the net inflows are heavily oriented towards STP route now than previously. Previously, STP, करीब 10% of our clients used to choose STP. Now about 30-35% of our clients are choosing STP. So the proportion of STP has increased. That's maybe one of the ways you iron out your luck factor. But if you don't choose STP, we will deploy even more eagerly. The cash components in our portfolios which used to be about 1%, they are now down to 0.2. Because we know we need every drop of the recovery when it happens. It will happen fast and it will happen very sharp.
Okay, so I'll just summarize what you said, that we know there is a light at the end of the tunnel, but we don't know how long is the tunnel. That's what I understand. And
so if you define, yes, let me define the tunnel in 2 ways. If the tunnel is fundamentals, we can see the light. There's no end needed. We are in the light. If you, I mean, obviously you can say Divi's Labs is not in the light, but everywhere else, I mean, there's no problem really. If you define tunnel as share price, then yes, your statement is correct. We know there is light at the end of the tunnel. We don't know how long the tunnel is, 3 months or 6 months.
So one last question now, since we are just 1 hour over, is there a plan to increase the number of stocks to 14 to 18?
That will be killing. Nahi karna ho. See, we can do that. I'll tell you what that will do. There are other quality-oriented funds as well. We regard them highly. They have delivered 1%, 1.5% better than us in the last 12 months because they are 30 stock, 40 stock portfolios. Right? 22 se shuru hota hai. 22 ka ek hai, ek 35 ka hai. Right? And you know the names I'm talking about. So they've delivered 1.5% better than us because they are 25 stock rather than 14 stock. But in the long run, in the last 4 years CAGR that we've had, or you had hamara Ambit ka 2 saal when we were fund managers there, whatever, whichever way you slice and dice, massively underperformed our 4 year CAGR. The COVID experience for them was, they outperformed the market by 10%, we outperformed by 35%. So net concentration in quality helps a lot, provided you don't make mistakes too often, right? If you make mistakes, adding 5 more stocks to the portfolio won't bail you out fully. It won't. If you make mistakes, adding 5 more stocks to the portfolio will reduce the pain only a little bit, but there'll be incredible pain. So assuming that array 5 stock add kar lete hain, just in case we made a mistake in buying a Divi's or a Dr. Lal, to wo offset nahi hoga, 1% se better ho jayega in the 1 in a 10 year event. But 9 in a 10 year mein 5% se niche ho jayega performance. Net, that's how you will see the long-term performance.
So before we end, I just want to give you the last word on the people who are worried, because who came in March after September 21, they're all in flat or negative.
Yeah.
So what would you like to end with? To
No, all I would say is that look, we are going through the pain with you when you define pain as 12-month performance. We are going through the pain with you. It's not a pleasant sight at all. But I mean, if you attend our, for instance, recent webinar on CCP done about 3 weeks ago on YouTube, you will have to sort of look long term. I know it's hard. I know it is hard, because if you started your journey only 1.5 years ago, you haven't got anything in the long term in your report, performance report of since inception. But that's where, I mean, I don't have an easy solution to this. Maybe the solution is, had you been invested somewhere else in quality, just look at their long term and get the conviction that in the long run, quality delivers, or look at the fundamentals of the companies rather than just the share prices. In the long run, only fundamentals deliver. That's all I can say. And we are very, very comfortable. I would like to use the word even excited, because we know the benefits of having gone through a crisis without losing your discipline. Massive benefits of going through a crisis without losing your discipline. This is last 12-month performance being weak is a sort of performance crisis, you can call it, right? But no, if you lose discipline at this point, then yeah, you'll make mistakes as fund managers, as clients, which are hard to recover from.
Okay. So I'll catch the word excitement to end this webinar. And I hope most of the questions were answered indirectly or directly by Rakshit. And thank you, Rakshit, for joining, and also openly and honestly sharing your views about the companies and the performance. And I'm sure this has put to rest a lot of queries and doubts. I'm sure till the performance doesn't come up, there will be still doubts in the mind, because as humans, we see performance first. However, market share gains happen, but if the price is not going up, it does not look good on the portfolio report. But thanks a lot for all to join and give your time. We are recording this event, and we will be put the recording soon who have missed it. Thank you so much.
Thank you.
Thank you, Rakshit.